This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Presidential pressure. Intel invests $7 billion in an Arizona plant, even as other companies continue to move some of their operations to Mexico. Washington whiplash, but is it possible that the way Washington works is actually putting a floor under the market? Made in the USA, why that is a complicated issue for some major pipeline projects. Those stories and more tonight on Nightly Business Report for Wednesday, February 8th. Good evening, everyone. I'm Sue Herrera. My partner, Tyler Matheson, is off tonight. The White House has been exerting a lot of pressure over U.S. companies to keep jobs here in the U.S. The automakers are prime examples. But today, it was Intel's turn. The CEO of the world's largest chipmaker says he plans to invest $7 billion in an Arizona semiconductor plant. And CEO Brian Krzanich announced the project in an unusual way from the Oval Office.
Fab 42 is an investment in Intel, but also the U.S.'s future in innovation and leadership in the semiconductor industry. And Fab 42 will employ approximately 3,000 direct, high-paying, high-wage, high-tech jobs at its peak, and over 10,000 people in the Arizona area in support of the factory.
But plans for the facility were actually put in place a while ago. In 2011, Intel said it planned to invest $5 billion in the Chandler, Arizona plant, but then Intel pulled the plug on that and said that it sat empty since 2014. Mr. Krzanich says he's going ahead with the project now because of potential regulatory changes. Despite pressure from the White House, many companies still have plans to move some operations to Mexico. The list includes big companies as well as smaller ones. According to the Wall Street Journal, Caterpillar and steelmaker Nucor are opening plants south of the border, as are General Motors and electronic component maker CTS. Rexnord is also going ahead with plans, despite President Trump calling out that company for, quote, viciously firing workers. The tech industry and the business world were waiting for a ruling on the president's immigration order, but the court said the decision would not come today. So on Wall Street, activity was muted as the recent stock surge took a pause and financial shares declined. The Dow Jones Industrial Average fell 35 points to 20,054. The Nasdaq rose 8 to a new high, and the S&P 500 added 1. Well, despite today's small moves, exchange-traded funds are having a big year, and it could be a sign that retail and institutional investors are getting back into this market. Dominic Chu tells us why ETFs are suddenly hot. Right, Dom?
All right, Sue. ETFs are just one of the vehicles by which investors, retail and institutional included, are putting money back in the market. And according to the folks over at BlackRock, which manages a lot of money in funds and ETFs, we've seen a huge year in 2016, specifically in the last 2 months. About $47 billion went into U.S. ETFs just in November, on the heels perhaps of the election, and around $59 billion again in just the month of December, two of the biggest back-to-back months on records going back to 2008. So a lot of money pouring into these U.S.-based ETFs. Some of the highlights, it's carrying over into 2017 as well, because in January, we were seeing some interesting stats here, Sue. ETFs globally took in about $61 billion in assets. That's the best month for inflows into U.S. and global ETFs overall since September of 2008. It's also the best January on record going back to 2008. And this is the interesting part, guys. U.S. small cap stocks took in about $4.3 billion worth in those ETFs. So it means, Sue, that over a fifth of all the money that went to U.S. exchange-traded funds just in January was in small cap stocks. So the question is, can that run continue? The market's, of course, near record highs, Sue. Back over to you.
Absolutely, Dom. Thanks so much, Dominic Chu. Well, while investors have been pouring a lot of money into ETFs since the election, Brian Reed is here, and he says he's seeing a return to normalcy in mutual funds. He is chief economist at the Investment Company Institute, and he joins us to talk more about this. Good to see you again, Brian. Welcome back.
Thank you.
What do you mean by a return to normalcy?
Well, after the election, I think there was an expectation that we would have some very quick changes in Washington, and people were exuberant, putting money into domestic funds, both ETFs and mutual funds. And we've seen now that return where we've gone back to a period where investors have kind of slowed down those purchases of domestic stock funds and kind of gone back to where they were before, putting money into bond funds and into global stock funds.
And how much of that do you think will continue if, indeed, things move a little bit more slowly in Washington than everybody, as you pointed out, anticipated at first?
I think we are going to return back to some of the strong demographics that have been driving investor demand. And they're taking their focus off from Washington, which is probably a good thing, and focusing on their own futures, their retirement, and what they're needing to do to build out for their own future retirement plans.
Now, there may be some changes under this new administration. One is this fiduciary rule governing how brokers give retirement advice to their customers, which is we've been covering here on NBR. The Labor Department late today sought to stay the legal challenge to that rule. What does that mean, and what would this rule mean for investors?
What the rule was trying to do is make sure that when you went to your financial advisor, you were in their they were making decisions for you that are in your best interest. And one of the challenges that I think has been is how to implement this. It's been very complicated. And so putting a stay on this, I think, would give us a little bit more time to make sure that no investors are hurt in the process of getting to that new standard.
Could it cause some market volatility, do you think, or not?
I don't think any market.
It's been in the market for a while.
Yes, it's been in the market. I think it's more about, are you going to continue to be able to go to your advisor and get the help that you need? And the rule is such a significant change that we want to make sure that there's enough time for everybody to implement it so they can continue to work in your interest, but doing so without being disruptive.
You mentioned that bond fund flows have increased. What does that tell you about the mindset of the individual investor?
I think what really tells me about the mindset is they're looking for income in retirement. And so we have a lot of baby boomers who have all of those 401k balances, and they're shifting a little bit away from stocks, putting into bonds, making sure there's a little bit more stability in their portfolios. And this is what you would expect when people are entering the retirement phase.
One of the things that you're keeping a very close eye on, and you recommend our viewers keep a close eye on, is the tax reform possibilities. Tell me more about that. So
we don't really quite know where this is going to go, but let's say if we had a reduction in tax rates, that would actually make taxable bonds look more attractive. Municipal bonds, which have a tax preference, would look a little bit less attractive because the yield on them wouldn't be as attractive relative to those taxable bonds to the lower rates. We could also see potentially some of the carving back of some of those special treatment for the municipal bond income, and that would make municipal bonds less attractive. So we saw right after the election investors pulling back from municipal bond funds. We're seeing money coming back in, I think, again, because they think Washington works in its own way.
And well, it's interesting. It's going to be interesting to see whether we have that stability throughout the year as Washington continues to work. Brian, nice to see you again. Appreciate it. Brian Reed with the Investment Company Institute. Mexico is our third largest trading partner. It exports goods to the U.S. worth nearly $63 billion more than it imports. That statistic is what President Trump keeps targeting. But it doesn't tell the whole story. Steve Leisman puts the pieces together.
To hear President Trump tell it, the U.S. is losing ground relative to Mexico and China on the wealth front. Here's President Trump from a meeting with Harley Davidson last week.
We're redoing NAFTA. We're doing a lot of our trade deals. And we're negotiating properly with countries, even countries that are allies. A lot of people taking advantage of us. A lot of countries taking advantage of us.
But the data tell a different story. The U.S. is actually pulling away from Mexico, and it will take decades for China to even get close. U.S. per capita GDP is around $52,000. That compares with just $10,000 for Mexico and $6,200 for China. So it's 5 times greater in the U.S. than Mexico and more than 7 times greater than in China.
We have been the world's #1 economy for over 100 years. And in that time, we've accumulated just enormous wealth. China is becoming a very prosperous and advanced country, but she's had about 20 years in which she's been able to really accumulate wealth.
The gap with Mexico, that's the blue bars, narrowed from 2006 to 2012, but it's widened the past 3 years. That is, whatever the unfairness in trade deals may be, the U.S. is getting wealthier relative to Mexico. Same story with China. It narrowed and has begun to widen yet again. For Mexico, it's a story of a bad education system and poor productivity of the average worker. Their northern manufacturing areas that do a lot of the exports do much better, but it's not enough to create convergence between U.S. and Mexican wealth. China's growth has slowed, but it's still higher than the U.S. It means that they're on track to catch up. But it will be 20 years for per capita GDP to just be on par with where Mexico is right now relative to the U.S. That is, 20 years from now, U.S. per capita GDP will still be 5 times greater than in China. For Nightly Business Report, I'm Steve Leisman.
Still ahead, the complexities of the president's America First energy plan.
President Trump said that he wants the pipe for large-scale pipeline projects to be made in the USA. Sounds simple, but it's not. That story coming up on Nightly Business Report.
The city of Seattle has cut ties with Wells Fargo. The city council passed the measure last night because of the bank's role as a lender to the Dakota Access Pipeline project. The bill directs officials not to renew its contract with Wells Fargo, which continues through 2018. The bank manages more than $3 billion of Seattle's operating account. Wells Fargo says it is disappointed by the decision and is ready to support Seattle with its financial services needs in the future. Oil prices finished higher for the first time in 3 sessions, but it's the pipeline industry that's getting attention. Just days after President Trump issued an executive order to proceed with Keystone's XL pipeline, the company building the project, TransCanada, reapplied for approval. But as Jackie DeAngelis reports from Little Rock, Arkansas, there are big questions surrounding just how quickly the project might proceed.
In a storage field just miles from downtown Little Rock, Arkansas, more than 50% of the pipe, over 300 miles, needed to complete the Keystone XL, sits idle at Wellspun Tubular, where it was manufactured, since before the Obama administration vetoed the project in 2015. President Trump said he wants pipeline pipes to be made in the USA, which some of them are. But he also said the steel used must be sourced here as well.
I want the pipe to be manufactured with United States steel.
No one knows exactly what the president means. Will all this pipeline be sold for scrap? Or does the executive order apply to future projects only? Currently, the steel for the large pipe used for these types of projects is sourced internationally. It comes from places like Japan, Korea, China, India, Italy, and Turkey. Still, U.S. steel manufacturers say they can make this kind of pipe, but they're not doing it right now. With more pipeline approvals expected, can U.S. steel companies meet the demand?
Right now, the U.S. steels and the Nucors have some, but they haven't had all of it. So we've had to source it from places like Italy and India. Most of the pipe has already been delivered for most of the pipelines, for the Dakota and things like that. The steel pipe is already there. So it would have to be new projects that they would have to ramp up for.
It's an important issue right now that needs clarification. The president has vowed to move forward with an America First energy plan. Getting this kind of pipe stamped made in the USA could be more challenging than he thought. For Nightly Business Report, I'm Jackie DeAngelis, Little Rock, Arkansas.
So let's turn now to John Kilduff to talk more about what's happening in the oil markets and where he sees prices headed. He is founding partner of Again Capital. Nice to see you, John.
Good evening, Sue.
Let's start. Jackie laid out kind of the pipeline industry per se. Right. But when we look at the oil industry, you're really looking at the supply-demand ratio, especially in light of the OPEC cut a while ago.
That's right, because obviously this is a global market, maybe more so than ever, considering the increase in daily higher amounts of U.S. crude that's being exported. Our guys are in the game globally. So now price matters really for everyone. So they're not necessarily as stranded as they had been previously to just our market. But you really have to look at this as on a global basis. And unfortunately, we are not still the low-cost provider. As long as prices are up here, $50 and higher, and the shale players have rushed to hedge their production, and that is lock in a future price to guarantee a profit for every barrel, they'll keep going on the rise. But if we tip over again like we did last year or over the past 18 months, they'll be in trouble again.
You're also pointing to China because China's demand for oil has been going down. A lot of people thought that it was going to continue to go up, and it's been going the opposite way.
That's right. We can even see them hit an air pocket of demand cratering. What the Chinese did, they took a stand or an idea to build up their own refining industry. They started these what are called teapot refineries, and they ended up making so much that they couldn't even use it internally. They started exporting record amounts of diesel fuel, gasoline, and the international market, particularly in Asia, got swamped. Well, they've woken up to the fact that there's a lot of pollution, a lot of problems with the industry. It looks like they're going to cut back so much that their oil demand, crude oil demand, may go down as much as 900,000 barrels a day over the course of this year.
Wow. And you point out the fact that even with gasoline prices really at pretty reasonable level, drivers are not driving as much as they were. Now, maybe that's seasonal. I mean, maybe it's the weather. Who knows? But that you're pointing to that as a factor for gasoline and for oil.
In a weekly report from the government today, the demand did pick back up to more normalized levels. But it had reached such a low level over the past several weeks that it was the kind of numbers or low break in demand that you would see during a severe recession. It was very worrying.
Why do you think that happened?
We believe that a couple of things happened. There is some consumer response to the higher price, slightly higher price, but a part of the demand number that the government publishes reflects exports. And there was a big price increase in Mexico that looks to have impacted exports to that country. So that's part of it. But it was really worrying there and a head scratcher to a degree for a while.
Well, if it's a head scratcher to you, it would be for me. That's certainly the case. You see oil prices moving back down to the $42 a barrel level. You've kind of laid some of that out, but is there one specific factor, do you think, that would drive it down that much?
Well, I think you have to applaud Saudi Arabia for their extreme efforts to support the price and rein in production and try to ease this glut. Unfortunately, they've done all they can. And some of the other countries involved who did not sign up for the deal, like Iran and Libya, are ramping up production in a big way. And the other killer for these guys now going forward here is that we're entering the spring, thankfully, even after a big snowstorm here in the Northeast tomorrow. And that's going to hurt demand, and that's going to hurt the price, at least for a time. They're going to have to do more. They're going to have to roll over the deal at least, but they got a lot of road to hoe here.
All right, we'll be watching. Thanks so much, John.
Thank you.
John Kilduff with, again, Capital. Intuit cuts its earnings outlook, and that's where we begin tonight's market focus. The maker of the TurboTax software said a slow start to tax season would cause profit and revenue for the current quarter to come in lower than initially expected. Shares fell fractionally to $116.55. Time Warner posted revenue above estimates, saying results were helped by higher subscriptions for its HBO channel and strong box office sales for the movie Fantastic Beasts and Where to Find Them. Profit also beat estimates, and Time Warner said it still expects its pending $85 billion merger with AT&T to close this year. Shares rose 38 cents to $96.60. Allergan said strong sales for its new drugs and anti-wrinkle treatment Botox contributed to the company's higher revenue, which beat street estimates. The biotech company also posted earnings that were ahead of forecasts. Allergan shares were up more than 3.5% to $241.17. Humana swung to a loss in its latest quarter, but the results were still good enough to top estimates. As the health insurer said, it benefited from higher membership in its Medicare business, but revenue fell more than expected. Humana also said that it would provide an update next week on its proposed merger with Aetna, a deal that was blocked by a federal judge last week. Humana shares rose 2% to $199.64. And same-store sales at Whole Foods fell for the 6th straight quarter. The grocery chain also posted lower than expected revenue, prompting it to cut its full-year earnings outlook. Following the downbeat news, the company said it was planning to refine its growth strategy. Shares initially fell in after-hours trading, but they finished the regular session up 1% to $29.30. And mortgage applications rose last week and interest rates fell. According to the Mortgage Bankers Association, total application volume increased 2.3%, but they're still running more than 20% below year-ago levels. On the cusp of the all-important spring housing season, an increasing number of local markets are mismatched. And that's because the lack of listings that we've been telling you about is preventing would-be buyers from finding what's on that wish list. Diana Olick explains.
What is a mismatched market? It's where the type of supply and the type of demand are completely out of kilter. We know supply is short everywhere, but in certain local markets, potential buyers are worse off than in others due to the type of supply available and not available. Trulia, a real estate listing company, measured searches versus available listings and found that, of course, it comes down to price point. Starter, trade-up, and luxury. There's a significant shortfall in starter and trade-up homes nationally and a large surplus of luxury listings. 27% of all searches nationally were for starter homes, but only 21% of listings were in that category. On the luxury side, 44% of searches were in luxury and 55% of listings were. Now, let's get local. The top 10 most mismatched markets on average, 4 are in Texas. Dallas leads the pack, followed by Houston, then Charlotte and Raleigh. Florida also grabs 2 spots, and Greenville, South Carolina, and Grand Rapids, Michigan round out the 10. The markets with the biggest shortfall of luxury homes, Philadelphia, Detroit, Memphis, New Orleans, and L.A. Interesting that all of those markets have a surplus of startup supply and are pretty well matched on the trade-up. So if you are a young buyer looking to get into home ownership, these are your best bets. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, will Cuervo investors be left with a President Trump hangover? Here's a look at what to watch for tomorrow. Dow component Coca-Cola is scheduled to report earnings. If profits and sales decline, it would be the 7th straight quarter of year-over-year drops. President Trump will meet with airline CEOs at the White House. The focus? Jobs. Weekly jobless claims and a few Fed speeches will provide some insight into the economy, and that is what to watch for on Thursday. And President Trump lashed out at the retailer Nordstrom over its decision to stop carrying his daughter's brand. He tweeted, "My daughter Ivanka has been treated so unfairly by Nordstrom. She is a great person, always pushing me to do the right thing. Terrible." Last month, Ivanka Trump said that she'd be stepping away from her management role at the clothing and shoe line that bears her name. Nordstrom has said that its decision was based on sales results and not politics. Shares of Nordstrom dipped momentarily after the president's tweet, but closed up more than 4%. 2017 could be a year of solid retail sales growth. The National Retail Federation says rising wages, lower unemployment, and a solid housing market are driving consumer confidence higher. The industry's sales are expected to grow between 3.7% and 4.2% this year. Online and non-store sales could increase between 8% and 12%. But there is a major headwind. This industry group's forecast does not include potential legislation, including the controversial border adjustment tax. And it is that border adjustment tax, which is also an issue for potential Cuervo investors. The world's largest tequila maker is set to go public on the Mexican Stock Exchange. But before investors take a shot of that IPO, there are a few things to consider. Landon Dowdy has our story.
A Trump hangover delayed Jose Cuervo's IPO twice last year after his election to the Oval sent the peso to record lows and sparked fears of an economic slowdown in the Latin American country.
The peso has gotten, weaker recently, but it's probably a good time to go public given the strength in their business and the strength in the category. So I wouldn't quarrel with the idea of taking Jose Cuervo public at this time.
The IPO comes at a time when tequila sales are on the rise. Since 2002, tequila volumes have grown more than 100%, with last month's sales outperforming the category, up nearly 10% in January. Jose Cuervo is a big piece of that, commanding a third of the global market share.
The whole millennial consumption of alcoholic beverages, including spirits, has been a wonderful, wonderful thing. They're very into premium. They're very into crafted product. And I think that's certainly benefited the rise in tequila.
The problem? The Mexican-based firm could be hurt by President Trump's U.S.-Mexican trade deals. The U.S. makes up more than 70% of its revenue, and Americans would likely rather not see a tariff on the product. Higher prices could drive consumers to other high-end tequila brands in what is already a highly competitive industry. For Nightly Business Report, I'm Landon Dowdy.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. Have a great evening, and we will see you right here tomorrow.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.